Have you ever thought to yourself, I wish there was an easier way to save money because I can't seem to set up a budget to do that? Well, if you have, then listen to this excerpt from the Borrowing Money Workshop income video. This video clip will introduce you to the 4 times per month or the 2 times per month pay method that will help you easily set up a savings account. So let's look at how you can create both a consistent monthly net income or net pay that will be used to easily repay your new loan and simultaneously create a savings account with little to no effort. Because having a savings account to pay for unexpected bills, repairs, regular maintenance, or savings for a big purchase such as a new gaming system or an engagement ring is a key to financial success. As an example, let's say that your gross pay is $1,200 per month. That equates to $62,400 annually, or $5,200 per month as the worksheet indicates. In this example, let's assume that $396 per week is taken out of your pay for taxes and withholdings, or $1,704 monthly. So your net weekly pay, or how much you have available to spend and pay bills, is $804 per week. That's $1,200 minus $396. Here's a question that you'll need your calculator on your phone for. How many weeks are in a month? Well, there are 52 weeks in a year. So dividing 52 weeks into 12 months equals 4.33 weeks average per each month. Here's how you can automatically create that savings account. Going back to the workbook, let's change how you are paid from weekly to 4 times a month. That will create an extra pay every 3 months that isn't being used in your monthly budget. Using your calculator again, take the monthly $286 difference between getting paid weekly and 4 times a month that you see and times that by 3 months. That equals one monthly net pay of around $804 that you can now put into your new savings account that you will open up at your bank or credit union after you complete this course, if you don't already have one. So how does that work? Looking at a calendar, there are basically 13 weeks in every 3-month period, or think of it as the 4 seasons: winter, spring, summer, and fall. So if you're basing your monthly budget on 12 weeks instead of 13 weeks, then you have an extra week of pay left over. So every change of the season, you are putting $804 into your savings account. After a year, you'll have almost $3,500 in savings by making this simple adjustment. The same concept can be used if you're paid every 2 weeks, as I am. This time, let's look at the salary income section. Using the same pay of $1,200 per week, that equates to $2,400 of gross pay every 2 weeks. So I'll enter that amount in the worksheet. The withholdings from your pay is doubled from $396 to $792. And lastly, the net income is also doubled from $804 to $1,608. Getting paid every 2 weeks means that you are receiving 26 paychecks each year. 52 weeks in a year divided by 2 weeks. So instead of getting paid every 2 weeks or 26 times a year, change the thought to getting paid twice a month or 24 times a year. 12 months times 2 pay periods equals 24. So you will now have, in this example, 2 extra pay periods during the year. So twice a year, you will be able to put $1,610 into your savings account. Using that calculator again, that $268 difference times 6-month interval equates to $1,608. I have found that these 2 extra pay periods typically occur in the early summer and late fall. Perfect time for paying for that vacation in the summer and property taxes and gift buying in the winter. If you found this simple trick a great way to start a savings account, then be sure to check out the Borrowing Money Workshop channel on YouTube for more great videos and tips. I hope to see you there.